Welcome to Allianz Global Investors webinar series. Today's topic is on our two tech funds, the Allianz Global Artificial Intelligence and Allianz Global Intelligent Cities. My name is Charles Ma and I'm your host for this morning's webinar. Since the beginning of the year, market volatility has heightened across the world, and the US tech sector is no exception. Today, we are happy to have Stephen Zhu, the portfolio manager for both funds, to give us an update on the US markets. Stephen has been the portfolio manager and member of the investment team for both artificial intelligence and intelligent cities since inception. The artificial intelligence funds was launched 5 years ago, and the fund AUM has now approaching $10 billion. The intelligent cities was incepted at 2021 and has already gathered $250 million of assets. Stephen has over 20 years of industry experience. He got his MBA at University of Chicago and is also a certified public accountant. On that note, Stephen, the floor is yours.
Thanks, Charles, and good morning to everyone. Calling in from San Francisco. I hope to be there live next time, but I want to start with just a quick market update. At a high level, obviously the market performance year to date, we've seen more volatility, really due to a combination of faster rate hike concerns, higher inflation, the Omicron variant, and more recently concerns over the Ukraine. When you look at the equity market performance in January, it was a bit more volatile. Some of the areas of the market that lagged in 21 have led, so things like emerging markets in China that were hit pretty hard last year. And we've seen more profit taking and weakness in some of the U.S. markets, particularly in technology and more in the small to mid cap area. If you look by sector, really by performance has really been led by last year's laggards that are a bit more tied to inflation and economic recovery in terms of energy and financials leading. But you've also seen more defensive parts of the market like consumer staples, utilities, also outperform better as some of the concerns around rates and inflation have driven more volatility in the market. Looking underneath the surface, looking at performance by market cap and style, while overall 2020 numbers were solid, you did see value and core strategies hold in better. As you go underneath the surface, you saw more volatility, particularly in the second half, where the growth areas of mid cap and Russell 2000 had more difficult performance, particularly in the second half of the year. The higher rate environment, inflation concerns really started to impact some of the longer duration assets. So far in January, and even, we've seen kind of that similar risk-off sentiment that started in the fourth quarter in particular, where the Russell large cap core index was down around 6%. Growth is down 9%. And if you go down in cap, you've seen the Russell mid cap growth down 13% and Russell's small cap growth down 13.4%. So, you've seen a bit more risk off as you've gone down in cap, and those longer duration growth sectors with slightly higher valuations have been impacted. Now, so far, month to date in February, we have started to see some stabilization as we continue to go through more quarterly earnings. The Russell 1000 growth is down 2% so far in February. Russell mid cap growth is up 1%, and the Russell 2000 growth is up 2.5%. So the small cap area. So we're starting to see some stabilization. Looking at the last several years since the pandemic had started, we've seen really a strong S&P 500 returns, really driven more by fundamentals. GDP growth has rebounded, over 8% in nominal terms. We've seen 14% revenue growth cumulative over the last 2 years and 25% EPS growth. On the right side of this chart, you'll see the market returns, and it's really been driven by strong earnings. So in the dark blue has been the S&P 500 returns. In the light gray area, you're seeing the next 12-month EPS growth. So really driving that performance. And then you've seen on the bottom, you've seen multiples contract a little bit, where the peak S&P 500 was around, call it around 23 times. And that has corrected over 10% so far. So it's more like around 20 times today. Looking by sector, While the market looks, a little bit expensive on 2020 numbers that were, really hit by the pandemic, the market is forward looking and pricing in a recovery and looking at more normalized 2022 estimates and now even 2023 estimates. PE multiple now on a forward basis are now closer to 2019 levels. So in the dark blue, the S&P 500 was 19 times before the COVID pandemic. And as we look to 2022 estimates, we're around 20 times. So we're really starting to see that recovery. If you look across sector, tech is around 27 times, kind of in line where it was in 2019. Healthcare is a little bit below at 16 times. Communication services at 19 times, slightly below what it was in 2019. While rate hike expectations have crept up, we still think the rate environment is still relatively low relative to history and can support the current multiples for the foreseeable future. And we think earnings growth can come in higher and really grow into the valuation. So, from here, it's going to be more of an earnings-driven market, we believe, versus multiple expansion. And multiples will continue to be slightly under pressure given the higher rate environment. Looking at the kind of rate hike expectations, you've seen obviously the U.S. 10-year Treasury yields inch up modestly higher with faster rate hikes now being priced into the market. We've kind of gone from 3 to 4 rate hikes expected in 2022 to closer to possibly 5 to even 6 rate hikes now, and we've done that pretty quickly. So the steepness of these rate hike expectations is what caused some of the volatility in the market more recently. Now, if you look more broadly, though, we are just getting back to that 2 to 2.5% on the 10-year Treasury yield that we saw back in 2017 and 2018. So while it is a faster hike cycle and the market's digesting that, we're just kind of getting back to levels kind of pre-COVID. And taking a step back, looking at over the past 4 rate hike cycles, you still have seen positive returns in the equity markets, with the S&P 500 gaining over 9.5% in the first 12 months prior to the first rate hike and 26% over the subsequent years. And so while this near-term volatility is a bit higher, we do think as the year progresses, you start to see more stability, and as the market gets comfortable with the inflation pressures kind of gradually easing, that the rate hike expectations will hopefully start to normalize. Looking forward at the artificial intelligence, I wanted to kind of give an outlook of positioning. As you know, we had a very strong 2020 where the global pandemic really provided a very strong innovation cycle with digital transformation. You saw a lot of the COVID-19 beneficiaries really perform well, particularly in the AI applications area. And as the year progressed, we saw broader participation in the market in our AI-enabled industries area. 2021 was a bit more of a challenging year due to a combination of 3 things. One, there were some style headwinds where this growth to value rotation in the second half of the year. And we saw a much more defensive mega cap market where, some of the mega cap defenses performed well, where, as I showed earlier, mid cap and small cap growth in particular were a bit more challenged. As we progressed through the year, some of the high outperforming stocks in 2020 started to have some issues forecasting their durability of growth over very high and elevated expectations. We still think fundamentally they're healthy, but obviously the valuations have come in a lot of these high growth names. We did see positive returns in AI infrastructure and AI-enabled industries, but the higher growth areas in AI applications lagged. Looking into 2022, we do think this monetary policy normalization is normal. We do think the economies will gain strength and become more self-sustaining. Market volatility should dampen as some of these supply chain challenges ease, and as we start to see some of the inflation pressures start to gradually subside as well. Overall, take a balanced approach in investing in companies in the AI-enabled industries area that are typically outside the technology area, as well as investing in companies that have really great long-term prospects and really investing for disruptive growth. And then looking at our outlook for artificial intelligence, really nothing has changed from a long-term perspective. In the AI infrastructure space, we continue to see very healthy build-outs of the AI infrastructure and significant growth drivers, whether it's cloud, 5G, IoT. We're seeing more investments go on to edge computing and electric autonomous vehicles. as well as leading edge manufacturing and a lot of more local manufacturing investments going on that should continue to benefit both the semi and semi equipment space. In AI applications, this investment in digital transformation continues to drive growth. We're seeing AI get embedded into more software applications and systems to drive better automation, faster decision making and significant cost savings. While valuations have come in, the fundamentals and what we're seeing in terms of growth is still very healthy. And in AI-enabled industries, we're seeing more and more companies leveraging AI to drive new innovations. We think the companies coming out of the pandemic that have strong balance sheets, that can invest in innovation, will continue to drive and distance themselves relative to their peers. We're still in the very early stages of the AI revolution. We're still in what we call narrow artificial intelligence, where machine learning is being applied to drive efficiencies for just one single task. Over the next 10 to 15 years, we'll progress to more general artificial intelligence, where AI can really be as smart as humans doing multiple tasks. But we're still probably 20 or 30 years out to what we see in the movies and full autonomous AI. And so we still think AI really is going to be one of the biggest drivers of innovation over the next several decades and be a bigger opportunity than the internet. We do think strategy across all sectors and with exposure to AI is very unique. I'm now going to move over to the global intelligent cities and just give you guys a quick update. As you know, the intelligent cities ecosystem is very broad, what we call infrastructure or building the city, really focused on the critical building blocks across next generation connectivity, data centers, smart buildings, and clean energy that are now being put in place to enable the city of the future. In the middle, what we call management or overseeing the city. Digital transformation is creating new solutions to better manage assets and resources more efficiently to improve the quality, safety, and sustainability of city living. At the very top, what we call city services or living in the city. New digital applications and smart services that really enhance the quality of life for people living and working in the city. Underneath that, we also look at the opportunity across 8 key themes that we think are really critical in driving new innovations to building global intelligent cities. I talked about the infrastructure areas before, and smart buildings, new innovations, energy efficiency, new automations, new types of filters and HEPA filters to drive better filtration as we start to go back to our cities post-COVID. Clean energy has really gotten a lot more investment ahead of us, creating more renewable sources. Things like the Biden infrastructure plan are very important to supporting that. We're seeing China now really start to commit more towards clean energy, renewable energy sources. In the mobility space, obviously, things like electrification drive it, but also lowering the carbon emissions and footprint across many different areas and transport systems are also important. And at the very top, everything from software and services that touch the citizens to healthcare services that we think are critical, to improving safety and security through better public safety and systems. What's going on in the connected home continues to drive new innovations, as well as what we're seeing in the sharing economy in terms of companies that are leveraging the sharing models to reduce those efficiencies. And we do think the intelligent cities opportunity is one of the next big opportunities that are out there. Over $3 trillion by 2026. Many investment opportunities to help build a better future through intelligent and innovative solutions. It is a much broader opportunity set, more opportunities to invest in more traditional infrastructure, as well as the management layer and more city services over time. Very high active share versus the broader indices. We do think as the markets remain volatile, this might provide more higher opportunity with a thematic multi-asset product.
Allianz Global Investors.